This is the Harness Money Report, a show designed to help anyone become a better investor. Every week, your host will break down a stock from beginning to end, the management, products, revenue, future, and so much more, all leading to the final stock verdict. Are you a bull or are you a bear? This show is for information and education only. Please do your own research before making any financial decisions. Thank you for being here, and now here is your host, Colin. Hello, and welcome to the Harness Money Report. I am Colin, and I have a wonderful show planned for you today. Every single week, I try to do my best to break down a company as much as possible. The management, the leaders, the revenue, the products, the competition, and of course, the stock. So I try to determine, is this company a bull or is it a bear? Am I interested in investing into this or am I avoiding this stock like the plague? So today I have a wonderful show planned for you. This is my very first episode and it's got a lot of great things in it. And today we are breaking down the company of NFLX. So remember, this show is for education and information purposes only. Always do your own research before making any big financial decision in your life. So now let's jump into it. Let's talk about NFLX. All right, so most people are familiar with NFLX. It is a global powerhouse. The ticker symbol for NFLX is NFLX. The stock price right now for NFLX is $607 per share. So a pretty high price for a stock at this moment, which just means that they have done very well in the past few years. So they are headquartered in Los Gatos, California. They were incorporated on January 16th, 2007. And most people are familiar with NFLX. So let's talk about an overview. An overview is that they have a larger market cap than Disney. That the stock market is valuing NFLX more than Disney, Comcast, Warner Brothers, or Max, Paramount, all these other companies. It is the leader of. Now, they've also been able to create viral shows and movies, including Squid Game, Bridgerton, You, and the one that I watched probably the most, which was House of Cards, which we will talk about in a little while. So they've been very good at creating content that has sparked conversation across the United States and across the world. So as of 2024, NFLX has a global subscriber base of 282 million monthly subscribers. So a very good number of people are paying every single month to get access to NFLX library of programs. Number of employees is 13,000. So that's actually pretty good. They've controlled the number of employees that they are hiring. So a business like Disney or Comcast has a lot more employees than 13,000. So they have really done a pretty good job of keeping that number pretty low. I do see that number of employees, though, growing over time as they expand more internationally. I feel like NFLX has really mastered the United States right now, that the future story next 10 years is going to be about international growth for this business. So the big top line question is, how does this company make money? And we already talked about it, and that is through monthly subscribers. They do have a couple different lines of revenue, but the bread and butter, the lion's share of their revenue comes from people paying monthly to get access to their shows and videos, to get access to the NFLX platform. And so some of the other ways that they make money is through advertising. So they just released advertising, and then they have physical products or product placement. So there are several different ways that NFLX makes money, but the primary is through the monthly subscription, and they have three different plans that they offer at this time. So number one is the standard plan with ads. So they just recently introduced their advertising model to the masses, and $6.99 is the entry-level plan for this business, and then you get to watch advertisements with your programs. I think this will become a bigger and bigger piece of the NFLX story going forward. And yes, it's adding more revenue to the business. Advertising is definitely adding more revenue to the business, but I almost see advertising for Netflix as a gateway to a few other services that they haven't quite explored, and that would be live events. So specifically with sports. So traditionally, Netflix has not done sporting events like NASCAR, football, or baseball, MLB, but they just did a deal for the WWE, and that is really paving the way for all kinds of different live events. And I feel like live events really lend themselves to advertising, that there's usually a break, specifically the NFL and Major League Baseball. There's always these breaks for commercials in the game, built into the game, these breaks for commercials. So that's really a way, this is really a way for Netflix to get into that game. And yes, it's expensive to buy the rights to certain events like the NFL, but you just pass that along to advertisers and you can make a lot more money. And it's a little bit more prestigious to be associated with these live events and have access to the people involved in those events. So that's the standard plan. The standard plan is $6.99. That's standard with ads. The traditional standard plan is $14.49. So this allows you to stream programs without commercials, and it allows you to stream in full high definition. So high definition. And then finally, the premium. The premium plan that they offer is $22.99 per month, and that is the most expensive plan that they offer, and allows you to stream up to 4K, so higher quality shows and videos. And then you can add on an extra person for $7.99 a month if you so choose. So it's always been that their subscription plan was the primary way that they made money, but advertising, product placement, licensing, those could all become a much bigger part of the business going into the future. Now, let's talk about the history of Netflix, because it is an interesting one, and it has really followed some mega cap trends, some big, broad trends have been in favor of this business. And it's also been a first mover. It was a first mover in the DVD space. It was a first mover in the streaming space. So let's get into it. So the business was founded in 1997 by two different gentlemen, Reed Hastings, which most people are familiar with, who's still involved in the business, and Mark Randolph. So the story goes that Reed Hastings, that he went into Blockbuster and that he rented a tape from Blockbuster. He came back to return the movie, and that was when he received notice that he had a late fee, that he needed to pay a late fee on his video. And that was kind of what sparked the idea that there should be a better way. There should be a better process than forgetting that you had a video and having to return it and getting a late fee. It's what if you could have a video as long as you wanted, return it, and then get the next video in the mail. So they were really one of the pioneers of the subscription model. So there was only a few, back in the 90s, there was only a few businesses that were really operating on a renewing monthly subscription, because that in and of itself, accepting payments on a monthly basis is a little bit of a work for a business. So less businesses were inclined to put in that level of effort in those days. Now, today, it's very common with people subscribing to newsletters, Netflix, software. So the two that come to mind is Netflix was one of the original to do it, but the other one was Salesforce. Salesforce was a pioneer with software, that they offered software on a subscription basis. And so that was what's born the idea of Netflix. And now the story also goes that Blockbuster at the time was renting tapes. They were renting VCR tapes, and VCR was the primary way of renting a movie and playing it at the house. So they had to do something that would change the game, because they didn't want to open 1,000 stores across the country or across the world. So that was where the DVD came into play. rediscovered that you could send a DVD in the mail and get it back. It could be returned to Netflix, not damaged, through the US Postal Service. So this is what allowed them to scale the business, reduce the amount of costs that they had to put into building a brick and mortar store. Instead, you could just subscribe to their service and they could mail you the DVDs, and then you could just send them back when you were done and get the next one in the mail. And it created kind of a prize. Like, people looked forward to checking their mail to see which DVD was coming in the mail next that they had ordered. So there were really all these different elements that they put together. And then it was all about the adoption of the DVD player. The DVD player and the DVDs. So most people were still using VCR tapes, and DVDs and the DVD player was just being introduced and just being adopted. So that was where probably a little bit of luck came into the picture for Netflix, in the fact that they were in Silicon Valley, that they were in California, where people were more of first mover adopters of the DVD, and they were near the movie business, so people were definitely interested in getting more DVDs and more videos that they could watch. So all of that played into their favor, and as DVD players became more ubiquitous, more people in the market bought them, that means that Netflix could reach more and more subscribers, that they could grow. So that was really what played into their hinted in the beginning. Now, they had to survive the dot-com bubble in 1999. They got through that, and then they went public in 2002. They began trading on the NASDAQ under the symbol NFLX in May 29th, 2002. So that is really what gave them the capital, what gave them the money to dramatically expand this business and grow it to new heights. And so throughout the 2000s, it was all about reaching new subscribers. And that is where the next mega trend comes in. And that is just the internet. That the internet was really taking hold, that more and more people were adopting internet, and the technology was getting better and better. Same with Amazon. As the internet grew, Amazon became bigger and bigger of a company. The same is true of Netflix. As more and more people adopted the internet, that is what would allow the next phase of the business, which was streaming. So by 2007, they were well into the DVD game, but then came the internet, and that gave them an even more efficient way to deliver content to their subscribers. So instead of having to mail, they could just upload one DVD onto their platform and deliver it through the internet to millions of subscribers. And that is exactly what happened. But not everybody was an adopter of the internet yet, and not everybody was on fast enough speeds to make it really valuable. So as the technology took hold, as the technology got better, this is what enabled Netflix to really take more and more market share of their business. And at one point, they were a significant user of the internet. That it was a significant portion of the internet was being used specifically by their subscriber base to watch television and movies, primarily movies in the beginning. But 2007 is really when it exploded, when they started streaming their own, not their own, but licensed content. So they started buying in the beginning content from Disney and 20th Century Fox and Warner Brothers, all these different studios, and putting their content on their platform. So in the 2010s, it was really all about global expansion. So they had reached everybody in the United States. That was when they launched in Canada and they launched in the United Kingdom. And the rest is history. Today, they're in over 100 countries in the world, and most people are aware of Netflix. So it's really been an international growth story since the 2010s. Now, During that time, another dramatic shift happened for Netflix. So Netflix was in the business of delivering content to their consumers, but at the time they launched their original content, it was still kind of up for debate if this was a good idea or not. So they began their original content in 2013 with the viral hit show House of Cards, which is a good show, and really launched them into the game of producing original content. And now, today, the lion's share of their content on their platform is original content. So they went heavy into the content creation game. But in the beginning, it was still a question mark, like, is this a good idea? Should they be competing with these other studios to create their original content? Would they be able to create high quality content? That was a question mark. And the debate was really around, should they buy content? Was it more affordable to purchase content from players, or create your own? Because Wall Street really thought at the time that it would be very expensive to create your own original content. And it is. It is expensive to create your original content. But I think what Netflix was realizing was that two different things. It was becoming increasingly expensive to purchase content from other studios. And it was also that they were afraid of the other studios walling off their content from Netflix, seeing Netflix as a threat, and therefore not putting that content onto Netflix. So it was really Netflix's way of hedging their bet, saying, we need to own our own intellectual property in order to protect ourselves from the Disney and the Warner Brothers, the HBO of the world. So that is when they jumped into the content game. And again, it has been gangbusters ever since. They've been creating their own content ever since, and it has been expensive. They continue to pay for original content, to create original content. So either way, whether they buy it from other people or whether they create it themselves, I think the cost of content creation will continue to go up over time. In every single decade, it will just become more and more expensive, especially as you have some very well-financed competition in the game. So now fast forward all the way to today, 2020 and beyond. So in 2022, Netflix spent $17 billion on new content, and then in 2023 it actually went down a little bit to $13 billion as they focused on cost control, which they are very much in the cost control mode right now, but also they have expanded their subscriber base. So they have been able to make their existing subscribers more profitable. So it's really just about that global expansion. And of course, what happened in 2020, we experienced a global pandemic, and that really worked in the favor of Netflix. It definitely shut down some of their production, shut down or slowed down some of their production capabilities, but having the whole world locked at home inside your house gave them a whole new subscriber base that they could capture, that they could get to subscribe to their service and grow their numbers and grow Wall Street's interest in this business, because Wall Street was shut down as well. They needed stuff to watch as well. So having Netflix there on their phone or on their television or their computer to watch really springboarded this business to get a lot more subscribers in the United States and globally. So they definitely got a huge chunk of subscribers at that time, but then it slowed down a little bit after that. But they'd already got the subscribers they needed, and it gave them the capital. So every single time they increase revenue, that gives them more fuel to put into their content creation machine. And it is a lot of content that they have to create, a lot of films and a lot of television shows and reality shows that they need to create to continue to feed the beast of their platform, give people something new to watch. So that is the treadmill that they will be on as long as they are an operating business. So what products does this business offer? Well, we've already talked about them. They offer movies, TV shows, online games, as well as physical products, things that you can buy, merch that you can buy. So their primary products are movies and TV shows, but they do offer online games. They have gone deeper into that space. So that is interesting. I always like to look at a business's acquisitions because that really tells you what they are focused on, and it really tells you about how the management manages the capital that they have. So I really think Netflix has been pretty smart about the acquisitions they've made. I found that they have made 10 acquisitions in their history, and they've really been pretty small. They haven't gone huge like Microsoft or Salesforce and making these multi-billion dollar acquisitions. They've kept their acquisitions relatively small. So in 2017, they acquired Millar World, which is a comic book publishing company. So I think that's pretty smart. They're pretty much buying IP, which was movies like Kick-Ass and The Kingsman. So they got some film and television adaptations that they could create. ABQ Studios, which was a film production facility in Albuquerque, New Mexico. Scanline VFX, visual effects company, and Storybots in 2019, which was an educational media brand focused on creating interactive content for children. So they really purchased a bunch of businesses that would boost the content that they were creating, that would give them more leverage to create new content. And then in the most recent years, they bought one, two, three, four different game production studios. So Next Games, Spry Fox, Boss Fight Entertainment. So studios that could create games for their platform. And I really look at gaming. I don't necessarily look at their gaming efforts as a big revenue driver, but rather I look at that as just a way to keep users engaged on their platform, to keep people connected into the Netflix universe. So that is their executives, let's talk about their management. So they are very unique. I've only seen this a couple times, is in that they have two chief executive officers, co-chief executive officers. The only other one that I know of that has really done this is Salesforce. Salesforce has had co-executive officers. So number one is Ted Sarandos. Ted Sarandos has been there a little bit longer. He's been there since 2000, and he was mainly focused. He was the chief content officer. So he oversaw hits like House of Cards and Orange is the New Black, and he was named co-CEO when Reed Hastings was in the picture. So he has been there for a while. He's been there a while, so he's definitely seen the growth and was instrumental in their developing their content library, and he has been handsomely rewarded. So his compensation right now is about $40 million. Same for the next CEO, is about $40 million. So half, 15.5, has been in RSUs, and let's see, I want to say 20 million has been in, 20 million was in cash, and 18 million was in equity or RSUs. So close to $40 million in compensation. So that is pretty significant. That's pretty high for a CEO. There's no doubt that they have performed, that they have grown revenue, but that is a good amount of money for a growth business, for a company. But Netflix likes to think of themselves as a technology company. So technology companies are notorious for having these large pay packages for their CEOs. So the next CEO is named Greg Peters, and he previously led streaming and partnerships. So he has really been involved in two different things, which are the partnerships, which has become very important for this business, and he was instrumental in the development and the launch of the advertising portion of this business, which I definitely think will become a future part of this business. So he is also compensated around $40 million for his efforts. And I think it's important that we talk about the partnerships, because what did we see in the past year, which were the strikes, the union strikes? That is definitely one of the risks that I see for this business. So Hollywood is very much a union town, in that you have 2 or 3 or 4 big unions: the Writers Guild, the Screen Actors Guild, and then you have directors, producers, the tradesmen union. So you have several different unions that control that town and can very much shut down production and shut down the pipeline of this business. So forming partnerships with the unions as well as the creative talent, the Shonda Rhimes, Tyler Perry, Reese Witherspoon, the really big players in that are the creative powerhouses, forming partnerships, developing partnerships with those people is very, very important. And then they have quite a big number of other people that are named in their C-suite. So their chief financial officer, I'll just go through a few, is Spencer Newman. Chief inclusion officer, Wade Davis. Chief talent officer is Sergio Azama. Chief or global head of partnerships is Maria Ferraris, and the list goes on and on. So they've got a good number in their C-suite, which I'm okay with, that they have that built out and they're ready for many different things that could hit them. Their board of directors, I always like to look at a board of directors to see who's on it, what names are there, because you'll see these names pop up in different places. These people that are serve on boards don't just serve on one board usually. They're usually on multiple boards, so you can see them, these names, or they serve on a board and then they become the chief executive of another business. So executive chairman is Reed Hastings. So I do like to see that one of the founders or someone involved from the very beginning is still a part of this business, and he is the executive chairman leading the direction. It bodes well for the future of this business, as well as you have Ted Sarandos and Greg Peters. Both of the co-CEOs are involved on the board, as well as several different people from around the industry, as well as political figures. It's always interesting to see political figures pop up in these businesses. From Apple has the former presidential candidate that ran against George Bush, as well as this business has Ambassador Susan Rice. So it's always interesting to see the political figures mixing in with the other business executives. So let's talk about the industry. The industry is film and television, aka media, the media industry, along with now the gaming industry and the advertising industry. So they're really competing in the media space. And who is the competition in that space? There's definitely a lot of competition against Netflix, but they have been able to kind of solidify their top position, their first mover advantage, and they have great technology. The app works well, the content is good, it's just a seamless experience. So I've broken down the competition into 3 different buckets: first, second, and third tier competition for this business. Number 1, the first tier of competition is the straight up streaming services that have been launched in direct competition with Netflix. So that is Disney and Hulu, or Disney Plus and the Hulu bundle along with ESPN. You have Peacock, which is Comcast. You have HBO Max, which is now Max, Paramount Plus, and then Apple TV Plus, along with Amazon Video Prime and BET Plus. So these are straight up streaming services that are competing directly for your eyeballs in the streaming space. Now, that is the first tier. I would say the second tier of competition is your traditional media, your classic media services. So that is traditional cable. So any traditional television, from live channels like the classic, the straight up NBC, ABC, CBS, those big channels, as well as all the different cable channels that are out there, along with movie theaters. Movie theaters I would put in the second tier of competition along with gaming. So Sony PlayStation, Nintendo, Microsoft, online computer games, those would be in competition as well. So those are all I would consider part of the second tier, people that choose to participate in those activities. And then finally, the third tier, let's call it anything that takes attention away from Netflix, people, so things that capture users' attention. So those would be your very traditional media like books, radio, music, and Spotify, sports, malls, work, amusement parks, and of course, what the big quote was, their biggest competition, Netflix claimed, was sleep. Sleep takes hours out of people's time. So basically anything that takes attention away from users from staying on the Netflix app is considered like the last third tier of competition. So they have a lot of competition, but I think that Netflix has really been able to stem that competition by providing great viral content that gets people to stick with their platform and really engage in their platform. So they've done a pretty good job. All right, let's talk about ownership. Let's talk about the stock. Get to the good stuff. And I have many different things that I like to look at with a stock. So I really separate the business and the stock into two different buckets because you can really kind of look at them two different ways. I want to see the business metrics growing, which are the consumers, the users, the clients, and then I want to see the stock. How are they treating the stock, the investment community that they are dealing with? Because they can really be two different things, and the way a stock is managed can be different from the business. So let's start at the top line. Total shares outstanding of this business. In 2023, there were 432.7 million shares outstanding, which that's a good number, but not the highest number of shares outstanding that I've seen by any means. But what I do like is that the share count did go down in 2023. So in 2020, they had 442 million. 2021 was 443. 2022 was 445. And then that's when the drop happened. It dropped down to 432. So that means that Netflix started buying back their own shares of stock that were outstanding on the market. So a lot of times you'll see the share count growing, that a business is issuing new stock to raise money, or they're issuing new stock to compensate the workers of the business. And when the share count of a business goes up, that means the investor ownership goes down. So as share count drops, that means the investor ownership increases. So as an investor, you want to see the share count going down over time. And that is what Netflix will continue to do. So the board has announced more share buybacks are coming. So that's what I like to see. I like to see the share count going down. But it's not necessarily a red flag if it is going up. So if they're trying to raise money or really increase the revenue of the business by getting a healthier balance sheet. So let's talk about share ownership. Who controls this business? This business is heavily owned by institutions. I was expecting to see a little bit more insider ownership of this business, but no, it's the institutional owners are by far the largest owners of this business. So institutional ownership is 80.90% of this business versus the insider ownership is only 1.38%. I was actually expecting Reed Hastings to own more of this business, but he's sold off a lot of his shares over time. So not a lot of insider ownership. The more insider ownership you have, it just means that the more incentive it gives the people working in the business to perform, because that would mean that would increase their bottom line, their own pocket. But that's okay. Businesses that eventually, if a business has been around long enough, you won't have insiders running the business anyway. So it's not a huge red flag that it's low insider ownership. Top funds, the funds and institutions that are owning this business. So the funds, I like to look at this just to know like what are the largest funds that are out there, largest ETFs, mutual funds that are owning different businesses, because most of the time they are passive, but they can get involved and really sway the trajectory of a business. So it's many of the traditional players, which is the Vanguard Total Stock Market Index, Vanguard 500 Index. So VTI has 13 million shares. VOO has 10.5 million shares. Then Growth Fund of America, Invesco ETF, Spider 500 ETF, Fidelity 500. The list goes on. The top institutional businesses or organizations that own this business are the classic usual players: Vanguard, BlackRock, State Street, T. Rowe Price, Capital World Investors, JP Morgan Chase. So many of the traditional owners, traditional funds own this businesses, which that can be another reason you look at a stock, is to see have institutions bought into this business or not. So once an institution decides to buy into a business, that can really drive the stock price higher of a business. So if it's a lower, smaller cap stock, a lot of the institutions may not be owners into this business, but then as the business starts performing, the institutions start gobbling up more and more and more stock, and that really dramatically increases the price. So that's something to look at. Does the business pay employees in stock options or RSU, restricted stock units? And you better believe it. Yes, they do pay RSUs to their employees. So something to keep in mind. Top insiders. The top insider owners of this business are Rick Kimball, owns 8 million shares. William Griffith owns 5.1 million shares. And then Reed Hastings is pretty far down the list, and he owns 2.9 million shares out of about 430 million shares outstanding. So his ownership is pretty small in this business, but he still has a very big influence on the direction of the business. So market cap, as we mentioned, this business is not cheap. It has a market cap of $262 billion in value. So that is what the total stock market is valuing this business at, $262 billion. And so that is one of the most important numbers that I look at. Most important numbers that I usually like to look at are market cap, revenue, and net income, to see, okay, how is this business actually performing? Market cap, to see if I'm investing into a business, you look at the market cap to see, okay, how much does it need to double or triple or grow in value to double or triple my money? So in order to, if you have a business like the mega cap, like an Apple, it's $1 trillion business. In order to double your investment in that business, that business will need to go from $1 trillion to $2 trillion. And so as a business grows, it kind of becomes bigger and harder to double and triple in value over time, but it can be done. Apple, Microsoft, Amazon, they all continue to crush the market. So it's very possible. So right now, stock price is $607 per share. The all-time high stock price for this business was $690 in October of 2021. So it's not too far off from its all-time high. And if you subscribe to my newsletter, the Harness Money Report newsletter, which is just harnessmoney.com, the Harness Money Substack, I have a great graph of the stock performance and just many different metrics that I have gathered together to talk more about the performance of this business, along with ratios. If you're interested in stock ratios, I have a lot of them posted on there. So dividends and buybacks. Does this business pay a dividend? I like to pay close attention to this as well. Does not pay a dividend, but does it buy back stock? Yes, the business does buy back stock. And in 2024, the board has authorized a $10 billion buyback. So it doesn't mean that they will use all of that money for a buyback, but the board has authorized that much. And I fully expect them to authorize more for buybacks over time to just increase the number of shares that they are repurchasing to reduce that share count. So it's not a dividend payer. So you're not going to put this in your cash flow portfolio, but they do buy back stock. So they're really setting themselves up as a growth story, that they are investing into this business for future growth. They're putting money into the content, into the actual infrastructure, and then buybacks in order to increase that share price over time. So now let's look at the financial statements. So now we're getting to the numbers that are really important. And the first one is the top line. Revenue, I consider the top line. Net income, I consider the bottom line. So top line revenue, all the money that they brought in was $33.7 billion in 2023. So I like to see it increasing that revenue clip by clip by clip every single year. And they have done a good job of this for the past good number of years. So in 2019 was 20 billion, 2020 was 25 billion, 2021 was 29 billion, 2022 was 31 billion, and 2023 was 33.7 billion dollars in revenue. So just every single year they're increasing the revenue that they are bringing in. And for many businesses, it can be lumpy. It's not always a straight line forward, but for this business, they've done a good job of increasing it up. So good for them. Where does the revenue come from worldwide? Now, this was really interesting. So I already mentioned that they have 282 million monthly subscribers. 44% comes from Canada, US and Canada. So basically North America is 44% of their revenue. So that was actually a pleasant surprise that it's less than 50%. I would have expected the US to be a bigger amount of their revenue. Europe, Middle East and Africa was 31%, Latin America was 13%, and Asia Pacific, Asia was only 11% of their revenue. So I fully expect Asia to be a bigger part of their revenue story in the future, that they're going to make more content for their Asian audiences to really capture more of those users, and India. So we saw Squid Game for South Korea, Japan, maybe the Philippines, as well as like Thailand, but a big one I expect to be India in the future. And I have again on my Substack, I have a really great revenue chart to show quarter after quarter how they have done in their revenue. So expenses have definitely gone up as well. So same thing. 2020, it was about 15 billion, then 17 billion, 19 billion, and today, 2023, was 19.7 billion. So they've really focused in the past, I would say 2 years, on trying to control their costs, their spend, and really grow that bottom line net income. So net income is probably what I laser in and focus on the most for a business. And in 2020 was about 2.7 billion in net income. That is 2020. So this has increased over time as well. So 2021 was 5.1 billion, so a huge jump. 2022, it dropped just a little bit to 4.4 billion in net income, and 2023 was 5.4 billion dollars in net income. So a healthy amount of net income that they are bringing in for their business. So that is really where I laser in and focus the most on a business, is are they growing their bottom line? So hopefully you're growing your top line, you're getting more revenue, customers in the door of your business, but then is that being translated into profits for a business? Because if a business is going to pay dividends, if they're going to do buybacks, it should come from this net income, or that should be returned to investors. That's what investors can consider the profits that are available to be used for them. But also a lot of businesses can use debt. They do use debt to pay dividends or buybacks. But if a business is being run really healthy and really well managed, then those things should come from net income. So the more they're increasing net income, the more money that they will have to pay dividends in into to their investors. So the balance sheet total assets was $48 billion. Total liability was $28 billion. So they are using debt, long-term debt, in order to fund the production of content, R&D, and really develop their product for their consumer. But I don't necessarily see that as a bad thing. So many companies are using debt in order to fund the operations of their business. And as long as they continue to grow and manage their debt well, then it really should not be a problem for this business. So it's really good. Their financial statements are looking really good. They've done a great job of managing the finances of this business. So now let's talk about potential success. So in the best case scenario, what could go right for this business? So it's pretty much that they continue executing on many of the things that have gotten them to where they are today. And that is really just creating that viral content, those viral movies, television shows that people want to watch, that people subscribe to this platform for this business. And really, I'm looking at, can this business execute on the international level? So can they create Indian and Asian content that really bring in those subscribers that cater to those audiences, but also translate over into American and European audiences, and that they can that if they execute on that, that is what will drive more subscriber growth in those areas that are currently being underserved. So that's really what could go right on the content portion of the business. Now, the other big driver is advertising. That is the big question mark, because that was just recently introduced. We've seen it get traction in the market, but they really will need to amp that up over time in order to make that a much larger portion of the revenue. I expect that they want this to be a huge portion of their business going forward and in time. So that is really the key. So advertising, if they can do live events like sporting events, they did a big announcement with the WWE and that business. So bringing that content onto their platform, if they can really succeed in that business, that could be a huge driver for their business, as well as gaming. So gaming is really a question mark. There's some big players in that business I don't really think they're going to compete with like a Nintendo or a Microsoft. But if they put enough resources behind it, and if they really create some viral games, that could really have legs. That could have tentacles in different area, from content, from video shows and movies that they could create for their platform, as well as engaging those die-hard gaming users to come to their platform. And that will really depend on the infrastructure of the internet, making the internet content better, making the internet networks have to be good enough that they can stream games online over the internet to homes and iPhones and different tablet products around the world in all these different areas. So gaming could be a big future for this business. What could go wrong? Potential failure. And there's a lot of pitfalls that could happen for this business, is that they just don't execute, that they stop creating that viral content. That's one that could happen to this business. Or the other one is that these other huge businesses like Disney, Apple, Amazon, that they come in and that they just buy up as much content as possible. Specifically creators, that they buy as many content creators as possible that they can, and really swallow up all of the talent for this business. Now, I don't necessarily see that happening. I think there's enough of a pie to go around. There's enough creators to go around in Hollywood that they're not going to all be loyal to just one particular Disney platform. But it is a risk. What's going to happen, is absolutely is that content will continue to get more and more expensive. So Netflix is going to have to continue to increase their subscriber base in order to pay the cost of all of this content, or they're going to have to go into a lot more debt in order to finance the creation of this content. And so the fear becomes, is content, the price of content, going to outstrip the profits that Netflix can make from the creation of that content? So the final risk is the one that we already saw happen, and that is union strikes. So the unions could definitely shut down a business like Netflix. If there's a long, prolonged shutdown, that could have effects on the long-term viability of Netflix. But we saw a pandemic. We already saw a actors and writers strike happening at the same time, and Netflix has been able to weather those storms. So I think they have a handle on those risks. So now it's time for the verdict. My verdict. Am I a bull or am I a bear on this business? So I am a bull for this business. I think they have done a good job of creating content. They've done a good job of managing the actual development of their pipeline of content. They have a good mix of television shows, of movies, of different content for children that they can run. They've proven that they can create international hits like Squid Game or Money Heist, and that they've proven that they're not just a flash in the pan, and that they can go up against the big players. That was the fear, that a company like Disney just had so much intellectual property that Netflix wouldn't be able to compete, and they've proven really that they can compete on a big level. What about the stock? Let's talk specifically about the stock. Right now, the stock is expensive, and they have done very well because they have profits. They have net income to return to shareholders. So the stock market is definitely rewarding the success of the business, which doesn't, I'm not afraid of that. A lot of investors try to find undervalued stocks and buy them and then hold them till they perform. But I'm okay buying expensive and having it perform even better over time. And I think this business will. I think they will become more profitable and will continue to drive revenue year after year. But it's definitely classified as a growth stock that they're going to need to perform year after year. They're going to need to beat the expectations of Wall Street to warrant this price, and to warrant the fact that they don't pay a dividend to shareholders. So they're going to have to really put in a lot of work to maintain this growth story in order to keep Wall Street satisfied, because there could be a big drop if they don't perform and they miss Wall Street expectations. That stock price could definitely drop. So it's not a perfect stock. There are definitely some risks involved in this stock. They've captured a lot of subscribers. So how many more can they capture throughout the world? I mean, I don't know. That is a question mark. How much content will they have to create in order to capture those users, those subscribers? That is a good question. But the thing that I also like about this business that has been an advantage to the stock was that they were the first mover into streamers. And it's a good sign when all the other competitors are following you. When Disney and HBO and Comcast all created their own streaming service, that really validated that Netflix was on the right path and that they have this foothold in the industry and they're not going away because they were the first mover. I also like about this stock, or in the business itself, is that they are focused on one avenue of delivery of content. So let's take a Disney. Disney has so many different arms or so many different segments that they have to serve, from movie theaters to television channels to their theme parks. it's really an ecosystem that they have to keep moving versus Netflix, which Netflix just has to focus on their one delivering content for their one platform, the one Netflix app. That is where all their content goes, and they can even bypass the movie theaters. Now, movie theaters can bring in ticket sales, can drive revenue for these businesses, but I think in the long run, it's probably better that they just surpass the theaters and deal directly with their app and their content and get to focus on this business. So I am a bull on this stock, and for a rating, a 0 to 10, I would rate this stock at an 8. So not perfect, but very high up there in my analysis of this business. So that is it. That is my very first Harness Money Report. Remember, this show is for educational purposes only. Do your own research and your own homework before you make any financial decisions. And thank you for watching. Come back every single week. I will be doing a show every single week. And remember, as an investor, make good money choices. Till next time.